Hello everyone, welcome back to Upside Down Data. Today I want to talk about a new risk indicator we just launched looking at Harmony and its native token 1. If you like the content, remember to subscribe to the channel, give the video a like, and follow us on Twitter where we put out regular updates about our risk indicators and more. So if you've been following the channel, you're quite familiar with these graphs by now, but if you're new to the channel, just to give you an overview of what we're looking at here, what I have here is the price of one plotted on the y-axis here in logarithmic form, and then I basically here just have the price action of one over time. So each dot here represents a day, and each dot is color-coded based on the output of our risk indicator, the upside-downside potential indicator, or UDPI for short. And what this indicator quantifies is risk. So a high score, a score of 5, means high risk. That's when the upside potential is quite low and the downside potential is quite great, so there's a lot of room to move downwards. And a score of -5 is when the asset's at a low risk point. That's when the downside potential is quite low and the upside potential is quite high. And so what you can see, and if you've been following the channel, this is going to be a familiar story. The UDPI is quite good at catching these low risk zones, these points where acquiring the asset, in this case 1, was quite advantageous historically, as well as these tops, these points where the upside potential kind of got tapped out, and then the asset oftentimes will correct off of that into these local bottoms. And then again, UDPI catches the summer as being a particularly low risk zone for 1, and then off we went to the races again. And so with 1, I think this is a case where 1 would have done really well to be following the UDPI indicator, because 1 did a 100x from this point to this point, and did a 50x from this point to this point. So acquiring at either of these points would have been quite spectacular return on investment at that point. And then even coming out of the summer, 1 has done about a 10x move, a little less than a 10x move coming out of the summer. So again, the summer was this fantastic time to be acquiring 1. 1 would have made a lot of money. A person investing in 1 would have made a lot of money had they invested in the summer and then sold. Either sold or, frankly, even just keep holding, because the UDPI does not think that 1 is necessarily tapped out its upside potential. The model thinks that it still could go on another run from here potentially. And I think that's something that's useful to talk about with this model. I've mentioned it in previous videos as well, is that the UDPI is a smart model. It's learning about the asset, and it's learning about it kind of as it sees the asset behave and perform. And so the UDPI realizes that 1 can be a quite explosive asset, putting in 100x, 50x moves here. And so it's going to take that into account, and it's going to evaluate what 1 does based on what its knowledge about what 1 is capable of. And so the idea is that given what the model has seen, given what's learned about 1, it still is quite bullish on it. Even though now it's kind of passed up above 0, it's looking like the upside potential might be a little bit lower than downside potential. There's still plenty of room to move to the upside, the model is suggesting. So another way that we can look at that and what the model is kind of thinking a given moment is just to look at the raw output of the model over time. So here we have now the UDPI output plotted on the y-axis, so 5, -5 here, and then we just have its output. And so you can see it's really kind of bottoming out at those low risk zones that we saw on the previous chart, and then really spiking up, shooting up here when we get to those tops of the asset, in this case 1. And so, as I was mentioning, what it's suggesting currently is that we did just have this 10x move out of the summer, but it still thinks there might be some upside potential left in 1, or quite a bit actually. It's still pretty far to go from below 1 all the way up here to a 4 to 5 range. And so it suggests that if 1 were to keep going up in price, it could still have a decent amount of room to move before it gets up to these scary levels. And just looking at the aspects of the 1 market right now, 1's only at a market capitalization of around $3 billion, which for a project of its size and as much attention as it's gotten is not crazy high. It would not shock me if 1 has quite a bit of room to move the upside. If it ends up having a market cap fairly soon of closer to 10 to 15 billion, it potentially could go even higher. Who knows how long? Depends how long this market cycle lasts, how high everything ends up going. 1 could end up putting in a lot of multiples from here potentially. Now, of course, none of that's guaranteed. We don't know if 1 is going to get back up to these high-risk levels, or if it'll start realizing this downside potential. It might need more time to consolidate here, or maybe even the price might even go down a little bit before it's ready to put more moves to the upside. Who knows? But the model is really suggesting that should it start moving to the upside, it has room to go. So none of that's financial advice. Do your own research, make your own decisions. But that's just what the model is kind of thinking about 1 in the current moment. And something that I think is also useful to talk about with this model, we've mentioned this before, so I'll just briefly touch on it again, is the way for this model kind of provides you with data-driven information about where an asset stands, in this case 1, and it lets you kind of cut out all of the noise you hear on Twitter, all the people who are, either calling for unrealistically high prices or unrealistically low prices in more bearish times, unless you just say, okay, what does the data actually tell me? Does this, according to the data, seem like a good time to be acquiring 1, or according to the data, maybe a good time to be exiting 1, to be selling off your position? And remember, like if you're around in the summer, 1 corrected pretty hard from this move up here. It was a move from about 20 cents at the top all the way down to, I think it hit around 5 cents at one point during the summer. It was a pretty huge correction. And so at the time, a lot of people were very bearish. And so, anyone in the market was expecting 1 to go a lot down, a lot further, along with basically the entire crypto market. But if you've been using the UDPI indicator, you could have seen, well, it's probably not super likely for it to go down that much further. We had gotten down to this -4 level here. It really seemed like it was unlikely for there to be much more downside potential. And then sure enough, we had that rebound out of the summer, and we ended up putting in, a 9 to 10x move out of the summer. And so if one had just been following the UDPI, following the data, one could have just cut out all of that noise and actually realized it was a historically fantastic time to be acquiring 1 at that point, and then ridden it to some pretty great gains so far, and who knows, potentially even greater gains in the future. So that's one of the things that I think is really helpful about these models, is they give you an indication of what the data says, and you can ignore what just these hot takes on Twitter are saying with nothing to back them up other than what these people just happen to think or what comes to their mind in a given moment. So to talk a little bit more about where 1 is at the current moment, we're sitting here at a value of 0.78. So what that suggests is that the downside potential is a little bit larger than the upside potential for 1 at the current moment. So it's a little bit, the risk reward is a little bit kind of against you if 1 were to consider, acquiring some 1 in the near future. But it's not a terrible, risk reward. It's kind of roughly even with a little bit more on the downside. So the model's not worried too much yet about 1. It's not at these really high risk zones where historically have been kind of that top level where you have to really be concerned. It's just kind of here in slightly overheated territory. So one of the other things we talk about a lot on this channel, and I'll mention again here, is the idea that having these indicators is not only useful for the indicator itself, but it's also useful to be able to compare the risk of an asset like 1 to other crypto assets and see what their risk-reward propositions are in the given moment. So what I'm showing you here is all of the risk indicators that we have created so far for here at Upside Down Data. We have, as you can see, we have 12 indicators going on currently, and we're adding more every week. So keep tuned to the channel if you want to see those new indicators come out as we launch them. What you can see, though, is when you just look across these, very quickly at a glance, you can see which ones are offering maybe kind of poor risk-reward propositions at the current moment. So, for example, DOT kind of leaning into some fundamental tailwinds, things that are really helping DOT's price appreciation. It's starting to look a little overheated. Would not be surprising if that starts to slow down at some point, or we'll just have to see what happens with it if it keeps going up. But you can also look at some of these other assets that are in the negative territories, like Algorand, for example, ADA, XRP, are all seeming to suggest that they have more upside potential in them currently than downside potential. So they might have a more favorable risk reward. And then there's some that are kind of hanging out more in the middle, kind of like where 1 is currently right now. So the idea is that if you're looking at all these, you can if you're kind of agnostic to the project, you don't really care too much which project you put into, you're just looking at risk reward, you just very clearly identify which ones are offering the best risk reward proposition right now. And then if an asset does start to really get overheated, so let's say, for example, DOT keeps running up, it keeps on increasing in price up into these really high risk zones, what you could do then is you say, okay, maybe I'll start taking some profits out of DOT and start moving into these lower risk assets which haven't really put in that big, huge run yet. And then you might be able to kind of compound your gains. So you make a bunch of gains in DOT, put those profits into a different asset, like maybe Algorand or Algo or something like that. And then when they run, then, or excuse me, Algorand and ADA, when they run, then you might be able to kind of compound those profits, make even more money off of that. So not financial advice, form your own strategies, but that's one of the really useful things about having this whole array of these risk indicators, is that you can see which ones are overheating, which ones you might want to be thinking about taking profits out of, and which ones you might think about investing in. So a final point I want to make in this video is another thing that's useful about the UDPI that's kind of separate from what we've been talking about before. So one of the things that we've done in this channel before for different assets, and I've done it again here for one, is that you can look at the risk of one not just against the US dollar, how much risk is there in the one versus the US dollar, but how much risk is there in one versus another crypto asset. And so, for example, Ethereum being this other really kind of popular asset, this other popular platform where DeFi and other decentralized apps get built on, you can ask the question, should I be buying should I be buying one right now, or should I be buying Ethereum right now? And the risk of one versus Ethereum in a moment gives you that information. So what I have graphed here on the y-axis is the value of one relative to ETH, and so basically this is how much ETH is one worth right now. And so as you can imagine, because an ETH is worth over $4,500 right now, and one is still in the cents range, you can see the value of one relative to one ETH is quite small. But what you can see is that this gives us an indication of relative performance. So when it's in a downtrend, when one is in a downtrend against Ethereum, that means that Ethereum is outperforming one in those moments. And then when one is in an uptrend relative to Ethereum in a given moment, that suggests that one is outperforming Ethereum. And so what you can see is that the UDPI can also pick out these kind of low-risk zones that have existed in one's history against Ethereum, and then really identify these tops, these points where one massively outperformed Ethereum, but then it was kind of unsustainably so, and then we got this big pullback off of that, where then one bled against Ethereum outperformed, one kind of had this consolidation zone, which the UDPI again then picked up as being a good time to be acquiring one relative to Ethereum, and then sure enough, now one has put in a lot of work. It's actually been outperforming Ethereum in the recent history coming out of the summer. So another thing that we can look at with the UDPI then is just to look at the raw output of that model. And so what you can see is that, again, it kind of shoots up, and it's really kind of pronounced with the one Ethereum valuation. It really just shoots up at that high point, that high risk zone. It was really just flashing warning that one was unlikely to keep on outperforming Ethereum at that point. And then it came down crashing down, and then again it was suggesting that now one had kind of bled too far against Ethereum, and that one was actually now likely having some upside potential against Ethereum. It was likely to start outperforming Ethereum in the near future, and then sure enough, that's what happened. And so right now we're kind of right at the midpoint here, which is basically suggesting that whether or not one will outperform Ethereum in a given moment, it seems like it kind of go either way. So, there's just as much upside potential for one against Ethereum right now as there is downside potential. So it's really just going to depend on which asset starts really moving first. If one starts pumping, going crazy, this risk will probably start going up, and especially if Ethereum just kind of stays still. If Ethereum really keeps on kind of moving up there, and one kind of keeps consolidating where it currently is, this will actually probably start bleeding downwards, and the upside potential of one against Ethereum will probably start increasing. And essentially what would end up happening probably then is that if Ethereum kind of peaks out, kind of has its run, then one will then follow it afterwards, and then the risk would shoot back up again. So that's just another useful kind of use case of this model, is that not only can you look at risk against the US dollar, you can also look at the risk against an asset like Ethereum and make these decisions of, is it a good time to be buying Ethereum versus one? At what point might we expect one to be outperforming Ethereum in the near future versus underperforming Ethereum? It's kind of already moved so far that's likely to be underperforming it in the future. And so it's just useful to look at those relative performance and then kind of what you can expect in the future. All right, so that's all I wanted to talk about today. Again, if you like the content, remember to subscribe to the channel, give the video a like, and give us a follow on Twitter, where we put out regular updates about our UDPI and more. Again, just a reminder, none of this was financial advice. Make your own decisions, form your own opinions. And of course, remember, with the UDPI, we're all going to make it.